and wondering if we should start telling dad jokes. One of the things my son and we've started doing is there's I don't know if you guys see this on YouTube, but they'll there's two comedians. They try to make each other laugh and they tell dad jokes.
Oh, really? Oh, yeah, yeah.
So
No, I've seen that. I've seen it on. I've seen variations of it. I don't know if I've seen the specific one you're talking about.
right, yeah. So we'll at nighttime when he's supposed to be off his iPad, he's like, "Dad, can we look at dad jokes on your phone?" So we'll sit there and we'll have a little competition of who laughs first. And
That's
some of
awesome.
this some of the stuff is inappropriate for a 9-year-old, but it provides a chance for him to win because I'll laugh hysterically and he doesn't know what's going on, or I don't think he knows what's going on. So,
Yeah. No, that's good. That's good.
well, Brandon, we're recording, man. We're live. People are going to hop in and out. Gway's here. Ramel's here. I know there's a couple of other people who are going to try to make it today for sure, but the replay is going to happen. It's going to consume by dozens and dozens more. And I'm number one, I appreciate you doing this. Number two, I appreciate you being flexible and rescheduling. I know we had an issue come up earlier when we had this in October, and I was like, man, I forget. I think we had I know exactly what it was. We had a death in the family. We had to go and reschedule. So we did this. We changed this up for us. So really, really appreciate it. Um, and looking forward to what you're going to talk about, because in this community, I have constantly struggled or expressed my frustrations with my CPA. I think we now have a better understanding of one another. Also know he's about to, I think he's gearing up for retirement in like the next year or two. So I'm going to transition. So all that being said and done, it's not just about me. It's about all the guys that are on here, the people who are going to see the replay. And we appreciate you coming on because we know you're an investor yourself.
Yeah.
Um,
Yeah. Well, hey, I've got a whole deck and everything, but before I launch into that, I'm just curious, what are the problems with your CPA?
um, we we don't see eye to eye on how aggressive I want to be with
Give me an example.
deductions. Um, so our primary house is we Airbnb it when
Uh-huh.
we don't live here about 6 months out of the year. A couple years ago, we went and bought an RV, and we were going to live in the RV full time, and we were traveling around, and primarily lived in Pigeon Forge, Tennessee. And we've been looking for a property up there, and we took this time. I was like, look, our house is rented out. We're living in the RV. We're going to take this time to get really plugged in. Went and looked at properties every week, and really got involved in with dealing with a couple of realtors, made 12 different offers over a couple of months, had one under contract, blah, blah, blah. So I looked at, okay, well, the RV is that's a business expense because we wouldn't be doing this if we weren't in that market, right? And I get it. There's some shady stuff. I mean, it's a gray area, right? Because his point was, hey, Jay, you can work with realtors remotely. And then when you find a property, you can fly up and look at it and you can pay for a hotel. You can pay for your trip. I was like, I understand that's the way that has been done in the past. But if I do that every time I find a property, number one, I'm going to lose on the property because if you don't make an offer at this time, this was like 2020, late 2021, early 2022, right? Where everything was going like moments it got on the MLS, right? You have to be there. I was like, I'm going to miss out on the property. And secondly, it would cost me more to do exactly what you like. If I'm just living at our house or wherever we're staying, right? Living nomadically, and I fly to Knoxville and drive over and rent a car and drive over and then spend the night and then do the whole thing backwards. It's going to cost me more, which is
Yeah.
going to be a bigger tax write off,
Yeah.
right? And so we kind of had it out over that. That's probably the
That's actually
grandest example.
that's actually a pretty complex
Yeah,
thing, and I don't know. I mean, it's very difficult to say which way you should have gone without knowing literally everything you have going on. But I will
yeah,
say that that there are a lot of accountants on TikTok and Instagram that will tell you you can do that all day long, and that's not totally true. So your CPA was probably right to press pause and explore it further.
Yeah.
I don't know what you guys ended up coming to, but
I
yeah,
love the
it's pretty,
professionalism you just had to say press pause and explore it. I love that.
yeah. Yeah. So the reason I asked, like, what are your problems with with your CPA is because normally it's I'm trying to explain real estate professional status and they don't get it. So normally it's like my CPA very clearly does not work with people like me,
Mm,
and that's where we see a lot of the problems. Like a lot of accountants know 750 hours and more time in real estate, the two tests for real estate professional status, but they don't know the nuances around the hours that count and don't count
mm,
to actually qualify. So you'll see them saying like, yeah, your education time counts, like the time spent watching this webinar counts, the time that you spend researching and traveling around and putting all those offers out, that all counts for real estate professional status. But when you look at all the tax court cases and you can kind of put it all together, you realize none of that time actually counts. So
yeah.
that's where I thought that you were maybe going with that. So anyway,
No, and he has. I've sat down in his office and after a couple of years of using him, and he just said, "Hey, I just want to be clear. You realize what you do is very abnormal." It's like yeah, I do, but I mean, I'm not a single W-2 person, and that's it. Maybe I got some stocks. It's like, yeah, that's not us. And
I get
so,
it. I get it.
yeah,
Well, good for you. Good for you. All right, everybody. Well, I'm gonna share my screen here. I'm gonna launch into this little presentation that I have built. Um, Here we go. Should be able to see it. Yep. Cool.
got it.
If you have questions while I'm going through this, like for the folks that are attending, feel free to just drop them in the chat. I'll have the chat pulled up over here on the side, and I can just answer them live. So don't be shy. All right. So my name is Brandon Hall. I run a CPA firm called Hall CPA PLLC. We're also known as the Real Estate CPA. If you look at us or search online for things like that, you'll find us there. I started the firm back in 2016. We have 52 U.S. employees now, another 35 offshore that kind of help us with a lot of back office type stuff, data entry. So it's kind of become this like full scale thing. We only work with real estate investors, at least as of now. I am exploring a couple different niches at this point, but real estate investors is our sole focus right now. So you have to have real estate or be right about pulling the trigger on your first rental in order to even qualify as a client to work with us. I'm a real estate investor myself. I have 25 units. 10 of those are duplexes. I've got a 3-unit. I've got a single family home, and then I have a short-term rental beach home that we Airbnb and VRBO. So kind of seen it all. We work with really small clients. We also work with really large clients. One of our largest clients is a $1.5 billion private equity fund that buys like 100 to 500 homes a month now. They were buying 1,000 homes a month at one point, and we do their entire back office, outsourced CFO services, accounting services, investor reporting, tax strategy, tax preparation. So we can work with the small folks, and we can also scale all the way up, and we've got specialized teams that handle that type of scale. So it's been really fun. I've met a lot of really cool people. I love real estate investors because we're all more entrepreneurial than the average Joe. And I love investing in real estate myself, and as reflected in my own portfolio. So today, what I'm going to talk about are the top strategies that you need to know. You might have heard this before if you've listened to any of our content, our podcast, our blog, anything like that. There's a high likelihood that you have heard this stuff before, but it still amazes me how many people haven't heard of anything that I'm about to show you, or don't fully understand how it works. So my goal here is just to help you understand what you could do and then go have a better conversation with your own accountant on it. So before we launch into the actual tax piece of this, I want to talk about the overall benefits of investing in real estate. We've got appreciation, right? Market goes up over time, generally speaking. It's a good inflation hedge because we're locking in long-term fixed debt. So our debt stays the same as our rents go up and as our incomes go up. It's great leverage returns, which is great in an up market and not so great in a down market. So hopefully we don't have down markets. But then we have tax sheltered profits. So how do we get tax sheltered profits? We get tax sheltered profits thanks to something called depreciation. We call depreciation a Vantum expense. And the reason that we say it's a Vantum expense is because you don't have to spend money to claim depreciation as an expense every year. You don't have to spend money every year. Additionally, you can buy the property initially however you want to. You can pay cash, you can finance it 100%, you can finance it 70%. It doesn't matter. Your depreciation expense is going to be the same. So depreciation is your purchase price less the cost of land divided by 27 and a half years. That is your annual depreciation expense that you get to claim every single year. So in this example, if I have revenue of 20K and expenses of 15,000, and my calculated annual depreciation expense is $6,000, I get to tell the IRS that I lost $1,000. But that's not what really happened, right? My revenue was 20, my expenses were 15. I actually made $5,000. I cash flowed 5K. That's cold hard cash that hit my bank account or my pocket. But I get to tell the IRS that I didn't make money thanks to depreciation. So it's a Vantum expense because it kind of layers on top, and I don't have to spend money to claim that expense on an ongoing basis. So that brings me to the difference between a tax loss and an operating loss. In the prior example, I showed you that we had a tax loss but operating income. That's good, right? We don't actually want an operating loss. We don't want 20K of rental expense, or 20K of rental income and 22K of rental expenses, and then $6,000 of depreciation, because now I have a true loss. It's cost me more money than I've made. So oftentimes, especially if people are investing in like syndication deals, they'll get a K1 back that shows this huge negative number, and they think that the syndication lost its shirt, but that's not what's really happening. What's being reflected is a tax loss after depreciation. And remember, depreciation is a Vantum expense. It's not cold hard cash coming out of your pocket. So a tax loss, if you have a tax loss, and if you can use a tax loss, that can equate to a tax benefit, because if I can use a tax loss to then offset my W-2 income or my business income, then I get to write that income down a little bit, which means that I save money on every dollar that I'm writing my income down. So the question becomes, can I use my tax losses? That tax loss of $1,000 from our prior example, how do I know if I can use that $1,000 tax loss to offset the income that my CPA firm generates for me? Well, in order to figure that out, we have to consult the passive activity loss rules. These rules were added in 1986. And basically before 1986, it was an amazing time to be a landlord. You could make all the money in the world. You could buy rental property. You could use all the depreciation you wanted to, create large tax losses, and you could use those large tax losses to directly offset your income. Didn't matter. There are no rules. Post 1986, what happened was there's two buckets of income now. There's the passive income bucket and the non-passive income bucket. Non-passive income is my like active income. It's my business income, my W-2 income. My passive income is rental real estate and any trade or business that I don't materially participate in. Okay, so I'm going to say that again. In my passive income bucket is my rental real estate and any trade or business that I do not materially participate in. So there's only two things that go into that passive bucket: rental real estate and any trade or business that I don't materially participate in. And the reason I keep harping on this is a lot of people think dividends and interest and gain on stock from selling my Tesla shares, all of that is passive income. And that's not true. That's not passive income. That's actually all considered non-passive income. Okay, the IRS doesn't care what sounds logical. They care what's actually written in the code. So all that stuff is considered non-passive income. It's actually called portfolio income, but for these rules, it's not going into that passive income bucket. And what that means is when I have rental losses, my rental losses can only offset income that's flowing into that passive income bucket. So my rental losses cannot offset interest income, dividend income, gain on sale of Tesla shares. It cannot offset my W-2 income, my business income, because all of that income's in my non-passive bucket. So my rental income is kind of trapped in this passive bucket. And if I have losses, those losses get trapped and they get suspended and they get carried forward until you generate passive income or you sell a passive activity at a gain. All right. So all my rentals after 1986 kind of go into this passive income bucket. And the whole goal of adding Section 469, which is the passive activity loss rules, was to prevent rich people from using real estate as a tax shelter. So they accomplished their goal by locking down what you could use passive losses for. Now, there is something else related to the passive income bucket that I want to talk about very briefly. It is that second piece, any trade or business that I do not materially participate in. So if I invest $100,000 into my local hair salon, and they're going to use that $100,000 as expansion capital, so they're going to go and add more stores. And as a result of me investing this $100,000, I become a profits interest partner, a capital interest partner as well. But basically, I'm getting a carve out of their profits. Now, I'm not sitting on their board. I'm not operating. I don't vote. All I did was put up $100,000, and now every year they're going to pass some profits back to me. Well, I'm not materially participating, okay? And so if we think about this passive income bucket, remember that second piece of it was, so the first piece was all rentals go in there, but then the second piece was any trade or business that I do not materially participate in. Well, if I've just put up capital and I'm receiving profits and I'm not participating, then that's a trade or business that I'm not materially participating in. So I could have this hair salon investment that's spitting off cash, right? Maybe it's like a super successful hair salon and I got in early and it's very profitable for me. And I can go buy rental real estate and generate tax losses from the rental real estate. And that rental real estate will, the losses from that rental real estate will offset profits from my hair salon investment because it's all grouped in that passive income bucket. So and that's a really big point that I want to make sure everybody understands, because when we talk about the passive activity loss rules and rental losses, the thing that everybody defaults to is real estate professional status. And that's a lot of work. So the better way is to figure out how to own a combination of rental real estate and businesses that generate income that you're not materially participating in, so that those things can offset each other. Think about Rich Dad, Poor Dad, the cash flow quadrants and everything. Well, this is Rich Dad, Poor Dad on steroids, okay? So we're the investor receiving cash flow, and it's also tax-free or tax deferred because I've structured the investments in my real estate in a way that's going to offset the business income that I'm earning. Okay, so there's a lot of power to just focusing on the passive activity loss rules and just in that passive bucket itself, if you're interested in investing as a passive partner in other types of businesses. People will do this with ATM funds. So there's a whole bunch of those ATM funds out there where you can make the investment, and there's a whole bunch of weird like marketing gimmicks around it too. You got to be really careful when you're investing in the ATM funds what they tell you about taxes, because it seems like nobody understands it. But the way that it works is if I invest in an ATM fund or syndicate, these guys are going out and buying thousands of ATM machines. I'm going to give them 100K. The income coming back, typically the first year, it's going to be a big loss because ATM machines are personal property, thus qualify for bonus depreciation. So that first year is going to be a big loss, but the second year it's going to be income, ordinary income. And that ordinary income is passive because I can't materially participate in the syndicate or the fund, no matter what they tell you, by the way. So don't fall for that junk. But I can't materially participate in the ATM syndicate or the fund. So the income that I'm receiving is passive, but that's not bad news because I can go and buy a rental up the street and I can cost segregate it, bonus depreciate it, accelerate the depreciation, create a big tax loss to offset the income that I'm getting from the real estate or the ATM fund. So you can kind of play this game in the passive income bucket itself. And you can really optimize your income streams, and it scales very well because all that income that I'm receiving from the ATM fund that I'm not paying tax on, what am I going to do? Roll it right into the next property next year to again offset that income stream. So you can really stair step it all the way up. It's awesome.
Real quick question, Brandon.
Yeah.
You keep saying materially participate, which I read as, man, that's really gray. There's no black and white in what that means. Can you give us a clearer definition of what that means, or is that written that way so it's up to whatever auditor's hands it may cross his desk?
Yeah, so I was actually just looking for a slide on this. I don't think that I have it in here.
Okay.
But when you, so material participation, we should just skip right down to, I'm right here. So material participation, So the passive income bucket, if I have a rental in the passive income bucket, in order to get it out of that bucket and put it into the non-passive bucket, I have to first qualify as a real estate professional, and I also have to materially participate in the activity. Okay. But if I have a business in the passive income bucket, I don't have to qualify as a real estate professional because that only applies to rental activities. But I still have to materially participate, because if I don't materially participate, then I am passive, right? So it is in the right bucket. It's in the passive bucket. So there's 7 tests to material participation. The 3 that we see most often, yeah, they are quantitative. So there's a qualitative piece, which is like you did a lot of work for a long period of time. Is kind of the qualitative piece. And the qualitative piece is also related related to what type of work are you doing on the business. Because a lot of people think that like I can underwrite deals all day long, and that's material participation. But that's not material participation, because that's what any passive investor would do. Like no passive investor is not going to underwrite a deal, right? So the idea is the idea behind material participation is, think of it as like rolling up your sleeves and getting your hands dirty. If you're kind of handing your money to somebody and you're putting a property manager on it and you're letting them run the deal, then you're not rolling up your sleeves and getting your hands dirty. So you're not materially participating. That's the qualitative idea. But there are quantitative tests. There's 7 of them. You only have to pass 1 of them. The one that we see most often is 500 hours. So I've spent 500 hours in the activity. Therefore, it's a non-passive activity. So it's now out of the passive bucket and it's put into the non-passive bucket. So think about that. That's your W-2 job, right? You spend more than 500 hours a year in your W-2 job. It's my CPA firm business. I spend way more than 500 hours a year running this thing. So I'm going to materially participate in my CPA firm business. But my rentals up the street, if I've got a property manager on those rentals, then I'm not the one that's collecting rents, managing the contractors, doing the repairs and maintenance, kicking tenants out and starting that legal process. I'm not doing all that, right? The property manager is doing that. So the property manager is materially participating in my rentals, but I'm not. And so if I don't materially participate in activity, then that activity is passive. And that's the key. And there's a whole bunch of like stuff. We have a ton of content on this stuff, because this is where accountants mess up. They mess up on what counts for real estate professional status in terms of what type of hours, that rolling up the sleeves type of work. What work does that need to be? And they also mess it up with material participation. And the problem is, when accountants mess it up, you're none the wiser, because this stuff's like complicated, right? So you don't know. You feel like you have done a lot of work. Everybody does. Don't get me wrong. Like I've got a 25 unit portfolio. I feel like it's a crap ton of work. But even in my portfolio, I have passive activities. Even if I think that that's unfair, it doesn't matter, because the IRS has definitions on what counts and what does not count. So
they have gray definitions, right?
Yeah. But
because I could argue, I could argue, and I feel like Gwaith would argue this point with me, is that underwriting a property, that to me is active participation, even if you're just handing the money over. I mean, for a guy who, let's just call it, somebody who's got money, who's going to come in as a limited partner. I mean, that is where they roll their sleeves up to be a part of the deal, right? They actively underwrite it. Now,
I would agree with you, but the tax court does not. So
that's right.
That's who you have to battle, right? And I mean, investor to investor, 100%. It's ridiculous. But there is a tax court case where an investor did just that. They underwrote deals for the entire year. They ended up closing on 2 of the deals in December, and they immediately handed them over to a property manager, and they were deemed to be passive activities as a result. So you really have to be careful with when you navigate these rules, because it's very facts and circumstances based. It depends on what type of activities you're doing. It also depends on scale. Like if you're running a real estate fund and you've got 1,000 homes under management, and your sole job is the acquisition, so that's all you do all day long, and you never do any of the management, well, you would be a real estate professional at that point. You are materially participating, right? But if you're trying to get into real estate, or if you've got one property and you're trying to buy another one, that's where the lines get blurred. Yeah. So
okay. Thank you.
So the overall point, though, is that you got to be careful in this area of the code, where we see taxpayers shoot themselves in the foot is by getting some FOMO because they hear somebody else is a real estate professional and that they're doing all this cool stuff and they're getting all these tax savings. And so they do it too. And their accountant just kind of goes along with it. And their accountant doesn't really push back or challenge. So Jay, that's what I was actually saying. You might actually have a pretty solid accountant there that he's pushing back. You'd be surprised. A lot don't. They just want your money. So it's on you to educate yourself on these rules so that you understand how it works, because you have to be so careful here around the concept of hearing what you want to hear, right? So you've got this cognitive bias. It's confirmation bias. You want to hear that you're a real estate professional. So if an accountant whose license tells you that you are solid, I'm a real estate professional, and that is not how it works. Because at the end of the day, it's you that's going to get audited. It's you that's going to have the interest and penalties if this all gets unwound. And the way that these audits work is, if I told 3 of you on this call bad advice related to real estate professional status, one of you gets audited and the IRS figures out that I gave you that bad advice, they're going to pull my P10 and they're going to see what other tax returns that I prepare that have similar facts and circumstances to the one that they just won the audit on, right? So then they're going to go pull all those other clients too, and they're going to nail them as well. So the audits related to this stuff can be very not random. And that just means that you even more so need to make sure that you're working with an accountant that understands this stuff and will also challenge you to do it correctly. A big telltale sign, if you're like listening to this and you're like, well, I have no idea if my accountant is going to do this right. If you're qualifying as a real estate professional, or if you're using the short-term rental loophole and you're going for the material participation stuff, if you get to tax time and you tell your accountant, I'm a real estate professional, I meet the test, or I've materially participated in my short-term rental, I meet the test. And if your accountant takes your word and does not ask you for a time log, then you are working with an accountant who's putting you at risk. Okay. We will not take a position without the time log, and we will scrutinize that time log and tell you to rework it if it doesn't meet our standards, because of how audit risky this stuff is. It's a heavily litigated piece of the code, and I think that people are really shooting by the hip when it comes to this stuff. But anyway, I'm going to get off my soapbox and we're going to keep going.
Yeah, let's go.
Yeah. All right. So passive activity loss rules, again, 2 buckets of income: passive, non-passive. Rentals go into my passive bucket. Okay. So my rental losses are trapped. How do we get them out? There's 3 ways to do it. 1, I sell my rental. If I sell a rental, then I can use the losses that were trapped to offset the gain on sale. All right. So I can unlock losses in that manner. The second way to use the losses from my passive activity bucket are if I earn less than 150K, I actively participate and I own 10% of the activity. So if I buy a rental and if I actively participate and if I earn less than 150K, I can claim up to $25,000. However, there is a phase out, which I'm not going to go over. So you can screenshot this, or you can pause if you're watching this on rewind. If I'm less than 100K in earnings, then I can take the full 25K allowance. As my income scales towards 150, the 25K loss allowance phases out. So if I'm earning less than 150K, I don't have to work as hard to claim some of the losses from my rentals. Active participation is let me see my laser pointer here. Active participation is a very low bar. It's basically like, do I have a property manager? Am I paying some bills? Am I helping the property manager make some decisions? That's active participation. Material participation is a much higher threshold. So you can be super passive, have property managers, actively participate, own 10%, earn less than 150K. You can claim passive losses from your rentals. All right. So that's the second way to get around these rules. The third way to get around these rules is to qualify as a real estate professional. And then the bonus way is to use the short-term rental loophole. So to qualify as real estate professional status, you have to spend 750 hours in a real property trade or business or businesses in which you materially participate, and you have to spend more time in those trades or businesses than you do anywhere else. I cannot be a real estate professional because I spend my full-time effort running my CPA firm. Okay, so if you have a W-2 job that you're working full-time, you can't be a real estate professional either. I'm an optimist. I believe that there are people that can spend more time in real estate, even though they are full-time in a job. I mean, like, it's not unheard of for people to work 80, 90, 100-hour weeks, so it's not out of the realm of possibility. The problem, again, is that you got to convince an IRS auditor and a tax court judge that that is the case. And nobody has been able to do that to date. So if you have a full-time job, or if you're running a business full-time, you cannot qualify as a real estate professional status as a real estate professional, at least per the current authority that we have of all the tax court cases that have come up or related to this. But if you can qualify as a real estate professional, if you do spend 750 hours in real property trades and businesses and more time in real property trades and businesses than you do anywhere else, then you can move that rental out of the passive bucket and into the non-passive bucket. So a really great thing that a lot of our clients do is, our clients will be married. One spouse will be a really high income earner, call them a doctor, business owner, salesman, whatever, 800K, $1 million. Spouse is a homemaker. Spouse qualifies as a real estate professional because we're building out a portfolio that's local to them. Spouse is managing the entire process. They're finding tenants. They're managing all the contractors, and they hit these hours, the 750 service hours, and it's all they do aside from taking care of the kids, which is an incredible job. The homemaker qualifies as a real estate professional, also materially participates in the rentals. When they file a joint tax return, it will be considered a real estate professional status tax return, which means that all those rentals, the losses from those rentals, can be used to offset the high income earner's income. So if the spouse qualifies, you can move all your rentals out of the passive bucket and into the non-passive bucket where your income is, your high income is. All right. So that's a really good strategy for anybody that's married. I'm not going to go over the real property trades or businesses just in the interest of time, but I will pause here for a second and look at the chat because I see somebody had a question. So you can screenshot this. But you have to spend 750 hours and more time in real property trades or businesses. So it's these 11 activities. Rommel, is it Rommel? I'm sorry. Rommel. Okay, great. Yeah. I make 300K, 1099, a W-2 plus 1099. You always said don't let the tax bill wag the dog, but in today's rate environment, does buying a short-term rental and doing the STR cost seg, not taking a huge profit or even breaking even in a couple of years make sense? Yeah, it's a great question. Things have definitely shifted. I am still so I'll tell you that a lot of our clients that bought short-term rentals are now struggling to make them work. The ones that let the tax tail wag the dog, and like there's always things that you can continue to do to optimize even after the first year, after you stripped out all that depreciation. But I'm still a big believer of underwrite the property, buy the property that works. Try not to let the tax benefit give you the few extra basis points that you're looking for to make the deal work, because the deal might not stand alone on its own merits. But that said, there are large, I know of a few larger shops that will buy property that they can use tax advantages on to give them that boost that they're looking for in terms of total IRR. So it is possible to answer your question. But I think that from what I've seen is we get a little too excited about the tax benefits, and then we forget that we still have this property that we have to manage. And I think with short-term rentals too, what a lot of people don't realize is it is a business. Like if you want to optimize it and build it, you have to actually work on it. It's not like I can just throw up an ad on Zillow and be good with it. Like I've got to really understand pricing and customer service and how to get reviews and how to optimize my SEO. And like, it's a lot of work. And I think a lot of people don't realize that and kind of get locked into the tax benefit piece. Okay, so we've been talking about like real estate professional status, material participation, hours that count towards them and hours that don't count. So let's talk about what doesn't count. This is considered not rolling up my sleeves, right? I'm not getting my hands dirty. Investor level hours do not count unless I'm managing the day-to-day. Okay, so this, Jay, is where you get that boost. So you can do all that underwriting, and if you manage the property afterwards, then you're good. But
What if you manage the property managers?
then you're not good. So you have to manage the day to day. So if you're managing the property managers are the ones that are managing the day to day, and you are now just in the investor seat. So if that's the case, then all that time spent doing the research and the underwriting will all be investor level hours and will not count. If you manage the day to day, all that time is still investor level hours because it's time any investor would spend to make sure they're buying a good deal. However, because you're managing the day to day afterwards, if you don't have a property manager, now all of a sudden all that time counts. So this is where the nuance kind of comes in. And whenever I give this stuff, especially early on, back in like 2020, I got like thrown into this whole like thing because we had built some stuff and then people came in and they were like, well, that's not what these groups are telling me. And so then these groups had me on and everybody always likes to challenge me on it. But so what I started doing is I just started including tax court cases. So this is a tax court case. Anything italicized is a tax court case. So the point is that when I'm talking to you, I'm trying to tell you as truthfully as possible and as factually as possible how this stuff works. And you're more than welcome. You can copy and paste that into your browser and you can read the tax court case if you so choose. Education and research time will not count. Here are 2 tax court cases that back that up. And then travel time is not going to count either unless, and this is the unless tax court case, so the positive, unless your properties are local to you and you're visiting them on a regular basis. So in this tax court case, they had like 10 properties or something, or 8 properties local to them, and they were managing them themselves and they were visiting them on a daily basis. So all that in the car time did count towards real estate professional status and material participation. But like my beach house is 2 hours away from my house in Raleigh, North Carolina. When I drive to my beach house, it does not count. The hours that I spend in the car do not count for material participation. Even if the trip itself is a business trip and otherwise deductible, because that's a different code section. This is how the Internal Revenue Code works. Sometimes they don't cross-reference each other. So you have to look at them separately.
Man.
Yeah. So I can still have a tax deductible business trip that's not material participation hours. Okay. So that's kind of how it works. I'm going to skip that slide. That's typically my high income physician slide. Personal service hours. So what does count for real estate professional status and material participation? These are all the hours that can count. Hours spent acquiring the property, asterisk, if I manage the day-to-day, right? Afterwards. Showing the property to tenants, placing rental ads, taking applications, screening, negotiating, cleaning, maintaining, doing the repairs, doing the improvements, supervising a property manager, Jay, only if I've got a large portfolio, okay? So if I've got a couple properties and they're out of state, calling the property manager up once a week is not going to cut it.
Large is relative.
What's that?
What does that mean? Large is a relative word. What does that mean?
Large is a relative word. And unfortunately, there are no bright line tests, so I cannot give you clarity. Yeah, that's how all this stuff works, and it's super fun. But the larger the portfolio, the more likely that you're going to be able to count this type of time, okay? So this is a possibility, but again, asterisk. Purchasing supplies, materials, inspecting the property, communicating with tenants, collecting rents, evicting, and then traveling to your rentals, but again, asterisk, if they're local to you and if you're visiting them on a regular basis. So when you look at all this, what I see is a property manager, right? That's what this is. This is a property manager. And the key point is that if you have a property manager and you have a small portfolio, whatever that might be, then you're not going to be able to count the time towards real estate professional status or towards material participation. And again, full circle, we want to count time for real estate professional status and material participation, because if we can qualify as a real estate professional and if we can materially participate in our rentals, then we're moving our rentals out of this passive bucket where the losses are trapped and they get suspended indefinitely. And we move them to the non-passive bucket where my income is. And the offsetting effect can be huge. Like we have clients that will net $500,000 from their W-2 and or their businesses. Their spouse qualifies as a real estate professional. They buy $1 million apartment complex. They cost segregate it, and they get a $300,000 tax deduction in the first year. And that's $500K of W-2 minus $300K, right? So you're getting a huge tax refund as a result of doing this right. But all these hours go into those tests. Don't try to game the system. You will, if you spend time in like various Facebook groups, not this group, but various Facebook groups, you will find that people will basically say, man, I'm taking all these awesome tax deductions. My CPA is great. You should give them a try. And in my experience, either they're doing it right and they're not fully disclosing all of their facts and circumstances. So those facts and circumstances don't match yours, or they're not doing it right. Is one of those two things. So just try not to get sucked into the FOMO, because for whatever reason, I mean, people hate paying taxes. So people love talking about saving taxes. People love marketing tax savings. If you ever look at syndications and things like that, it's super easy to talk about because everybody hates paying taxes. But try not to get sucked into, oh, well, that person did it, so I must be able to too. Because either they have different facts and circumstances from you, or their accountant is not doing it correctly, which is exposing them to some massive risk, and they might not even realize it. And we see this a lot in physician communities online. So here, I guess I did have a slide on the material participation test. So here are your 7 material participation tests. In the interest of time, I'm not going to hit all these rules, but I will hit 1, 2, and 3. These are the 3 rules that we see most often. So if you spend 500 hours or more in the activity, then you are materially participating. If your participation is substantially all of the participation, meaning you did all the work and nobody else lifted a finger, then you are materially participating. And the interesting thing about number 2 is that in theory, you could get there with like 50 hours, right? So if I spend 50 hours on my beach rental and nobody else does anything, I don't have cleaners, I don't have repair guys, I don't have a property manager. Well, my time, my 50 hours is 50 hours of total time spent. So my time is substantially all the time. In theory, I have materially participated in my beach rental. Let me keep going. The third test is 100 hours and more than anyone else. So if my cleaners spend 102 hours on my short-term rental and I want to materially participate, then I have to spend 100 hours and more than my cleaners. So I have to spend 103 hours. If Jay and I are partners on a rental property and we both know that we want to materially participate and Jay spends 106 hours, what am I going to do? I'm going to spend 107 hours because I want to materially participate. Well, when I spend 107 hours, now Jay has spent 100 hours, but not more than anyone else. So he's no longer materially participating. Isn't that funny how that works? So typically in partnerships, we actually see a stair stepping all the way up to all partners spending 500 hours that want to materially participate. So partnerships can get kind of dicey with this stuff too.
And just for clarity, you said you just have to hit yes on any of these rules, not all of them.
Correct.
Right? Any.
In order to materially participate, you must meet one of these 7 rules, but you're typically going to meet one of these 3 rules.
Top 3. Okay.
So these are not ands, these are or, right? Participate more than 500 hours, or participate 100 hours and more than anyone else, or substantially all. Now, what I do want to point out is the material participation piece. When you are a real estate professional, you still have to hit 750 hours, and they have to be real hours. So sometimes we see accountants say, well, you can spend 500 hours materially participating and then 250 hours, because 500 plus 250 gets you to your 750 reps hour test. You can spend 250 hours on anything else, education, research, and that is not true. The IRS will throw all that out. So your 750 hours has to be rolling up my sleeves hours. It's 750 material participation hours. So sometimes we get clients that get confused. They're like, well, I participated 100 hours more than anyone else, so I'm a real estate professional. And no, you still have to spend 750 real hours to achieve real estate professional status. Now, I'm not gonna hit that. That's a little too confusing. Okay. I want to hit this because we've got a couple minutes, then I'll hit questions. So we've talked about real estate professional status. If you qualify as a real estate professional and if you materially participate in the activity, then you have moved the rental out of the passive bucket and you've put it into the non-passive bucket. And now you can do all sorts of fun things like a cost seg study and bonus depreciation to create large tax losses. And you can use those large tax losses to offset your W-2 income or your business income. The problem, though, is what if I'm a high income earner, but I'm single? and I work full time, or I run a business full time? Or what if I'm a high income earner, but my spouse either does not have time to manage the rentals and qualify as a real estate professional because my spouse is managing our kids or running her own company or has her own job? Or what if she simply just doesn't want to? Because those are real facts we have to consult, right? Like typically when we do consultations with clients, they get all gung ho about tax savings, and it's the high income earner that we're talking to and not the spouse. And so we're always like, well, what does your spouse think? And they're like, oh, she'll be on board or he'll be on board. Like, well, why don't we get them on the call just to make sure? Because this is a lot of tax planning that we're kind of counting on them being a part of. So your spouse has really got to not only have the capacity to do it, but the want to do it. And what happens if they don't? Well, if they don't, or if you're single and you're working a full-time job, you can't qualify as a real estate professional. So all the rentals that you purchase, all those tax losses are going to be passive losses, and they'll be suspended and carried forward. You won't be able to use them to offset your regular income. But you can buy a different type of rental to get around all of that. So if you buy short-term rentals, and this is where the whole short-term rental loophole rage comes from. If you buy short-term rentals, if the average period of customer use is 7 days or less, I have given this presentation like 100 times. I always say this should be less than or equal to, and I always mean to update it, and I never do. This should say less than or equal to. So it's 7 days or less. If your average period of customer use is 7 days or less, then you do not have a rental activity under Section 469 of the Internal Revenue Code. The significance is that real estate professional status applies only to rental activities. Okay? And real estate professional status says 750 hours and more time in real estate than anywhere else. So real estate professional status is the blocker to having a full-time job and being able to deduct my losses because I have to spend more time in real estate than I do my full-time job. So if I don't have a rental activity, thanks to this weird regulation, then I don't have to qualify as a real estate professional in order to make this a non-passive activity. Okay? This is just like any other business. It'd be like if I invested in that hair salon. If I invest in the hair salon and I start working in the hair salon, then I'm probably going to be materially participating. It's the same concept. So even though we think of it as a rental property, the IRS views it as not a rental activity. And because it's not a rental activity, I don't have to qualify as a real estate professional, but I still have to materially participate. So if I materially participate in a short-term rental where the average period of customer use is 7 days or less, then my short-term rental is moved out of that passive bucket and it's put into the non-passive bucket. And I can cost segregate it and I can bonus depreciate it and I can use the tax losses to offset my W-2 income. I don't need to spend more time in real estate when I'm buying short-term rentals because I don't need to qualify as a real estate professional because real estate professional status only applies to rental activities. And if I have a property where the average period of customer use is 7 days or less, I don't have a rental activity. So it's a pretty sweet carve out that you can utilize if you're running Airbnbs and VRBOs, or if you're even self-managing short-term rentals. But it enables you to acquire short-term rentals and immediately receive a tax benefit against your regular income. You still have to materially participate. So you got to meet one of these 3 tests. You don't have to meet all of them, just one of them. And you have to log your time. You have to have a time log. If you have cleaners, you have to track their time. A lot of video cameras and doorbells these days, like you can use different types of doorbells that have a log of who enters your building and when they leave. So you can assign like certain codes to your cleaners and your repair people so that you know when they come and when they exit. That way you can actually have a time log for their time, because there was a tax court case in September of 2021 called Lucero versus Commissioner, where Lucero had a few short-term rentals and argued that the taxpayer spent 100 hours and more than their cleaning service. But the tax court said, you've presented zero information as to how much time your cleaning service has actually spent. Therefore, we have no idea if you've spent more time than them. Therefore, you're passive. So if you're going to hit that type of test, you do have to track your contractor's time. But this is super powerful, and this is related to Ramel's question earlier. If you are able to buy property that is short-term rental, even if it's short-term rental for the first year, you can convert it to long-term rental later. You can go passive in a future year, right? It's just the year that I buy it, average period of customer use has to be 7 days or less, and I have to materially participate in the year that I buy it. Then I can cost seg and I can bonus depreciate it. And I can get a large tax write-off against my W-2 and my business income. It's very, very powerful. Jay, so I come off. Do you have a question?
Yeah, well, so let's say, hypothetically speaking, we'll use your, if I remember correctly, you had 25 rentals, right?
Yes.
One short-term rental. And under that temporary code that you just mentioned, that applies to your short-term rental, but does that apply to your rest of your portfolio as well?
That is a wonderful question, and the answer is no. So the rest of your portfolio, if the average period of customer use on the rest, if the average period of customer use is not 7 days or less on each of your different rental activities, then the ones that it's not, those are still passive. You have to qualify as a real estate professional. But for your rentals that do achieve this, let me get rid of that. You don't have to qualify as a real estate professional. So it becomes really, really powerful. But cool thing here, right? So I could buy a short-term rental this year. I could cost segregate it, I could materially participate, make sure the average period of customer use is 7 days or less. I could bonus depreciate it. That'll give me a big tax loss that I can claim against my income, against my CPA from income, because I'm materially participating in my short-term rental. Starting in January of 2024, I can hand that off to a property manager. And even if the average period of customer use is 7 days or less, I'm not going to materially participate because now I have a property manager running it. But typically what happens with these short-term rentals, what do? After the first year? They generate income, right? And I've already stripped out all that depreciation through the cost seg in the first year. So I'm going to have taxable income from these short-term rentals going forward. Well, guess what? If I remove myself from the situation and put a property manager on it, and now it's passive, and it goes into my passive bucket where all my other rentals are, and all my other rentals are generating tax losses, then I can use my other rentals tax losses to offset my short-term rentals tax income.
Yeah, and this is why this is so complex. This is why having somebody like you in place to help us navigate this, because most everybody, I'm going to speak for everybody here and everybody watching the recording, we all want to pay less taxes.
Yeah,
you said that earlier, right? And that is a very interesting thought.
Well, and what we try to do at our firm too is help people think through the timeline of that. Okay, because everybody would love $50,000 back in their pocket today. No question. We're not going to argue with you about that. But what we want you to think about is, how do you structure your portfolio, your acquisitions, and how you work in your portfolio so that 5 years from now, you have significant passive income streams that are tax sheltered, right?
Yeah.
So it's more than just about, let's offset my W-2 income today. That's the dopamine rush that everybody chases.
Yeah.
But the real wealth is 5, 10, 15 years from now, if I keep chipping away, I don't know, chopping away.
Chopping away. I was going to go with chop too. Yeah.
Lumberjack. If I keep chipping away at this plan, then over a decade of doing this, I have to win long term, right? So it's understanding. What we try to help people do is understand how the passive activity loss rules work, and then also how could you structure future portfolios so that you don't have to work and you still get great income that's tax sheltered. That's the dream. And this is part of it, right? So you can have a short-term rental today that you materially participate in. You strip those tax benefits out via cost seg, bonus depreciation, and the big tax losses. And then you flip it over to passive next year because you put a property manager on it. And now that income that it generates, the taxable income that it generates, you can buy another rental next year. You can invest in a syndication next year. And that can all be passive. You don't have to qualify as a real estate professional. those will create tax losses that can be used to offset your short-term rental income, net income. So it's just this
Very interesting.
beautiful offsetting effect. We don't have time to go over the Schedule C and the self-employment tax stuff, but typically when I give this presentation, I include this now because when I used to give this presentation, people would always ask, well, if the short-term rental is not considered a rental activity, then that means it has to be reported on Schedule C. And a lot of accountants fall into this trap, less so now because we've been so vocal with our content that they all like, I feel like we put them all on the right path. So it's good.
Yeah.
I see them like regurgitating it. I'm like, good, that's great. Give me a shout out next time, but still, I like
Yeah.
the
Yeah.
but in all seriousness, like we ran this entire podcast series on it, and we have like 130,000 downloads a month on our podcast. And so when we started putting this out there, the tide finally changed to what we were saying. Basically, your short-term rentals should not be on Schedule C. They should be on Schedule E. There is a small percentage of short-term rentals that should be on Schedule C, but like you're kind of there providing them tours and you're providing them with a golf cart to ride around it. Like you're doing stuff way above and beyond just here are the keys, enjoy your stay. All right. We don't have time to go over the next two slides, but I'll just kind of hit them very, very high level. Whenever you get to the end of your investing journey, you can whenever you get to the end of your properties ownership, you can 1031 exchange it, which just kicks the can down the road. Here are the rules for the 1031 exchange. You can 1031 exchange even if you've done a cost segregation study. And when you 1031 exchange, you're basically trading 4 greenhouses for 1 big red hotel. If you remember Monopoly when we were all growing up, and you're just deferring the gain, you're deferring the depreciation recapture, and you're just putting it into the next property. So a lot of our clients will 1031 exchange, and they'll swap until they die. So swap until you drop, because when you drop, guess what? Your heirs get a stepped up basis. So all the depreciation recapture goes away, all the capital gains go away. They inherit the property at the value of the time of your death, and they can restart the depreciation schedule at that time. It's a really beautiful thing. And if you are in a syndication, you can do a 1031 exchange in a roundabout way without doing a 1031 exchange. So you can't my CPA firm is a partnership. I can't take my partnership interest and exchange that for another partnership interest. So the point is you can't 1031 exchange in a partnership unless the entire partnership decides to 1031 exchange the building itself. But what happens with syndications is the syndication will liquidate and then shut down, and then all the LPs are left with a really large gain that they then have to pay tax on. But what you can do is just invest in the next syndication in the same calendar year. And you could have actually invested in the new syndication January 1st, and then the old syndication liquidates December 31st. So it can be backwards. As long as it's within the same calendar year, the new syndication will pass depreciation through to you, which will create a tax loss, which you can then use to offset the gain on sale that you've received from the syndication that's liquidating. So it is in effect a 1031 exchange because you're taking more depreciation to offset this gain, and so you're just sort of rolling the gain into the new syndication in a roundabout way. And we actually call that the lazy man's 1031 exchange. You could do this with property too. It doesn't just have to be a syndication. Like you don't have to 1031 exchange a property. You could sell a property today, and you could have bought a property in January of this year. If you sell a property now, it's all in the same tax year. So you can cost segregate the property that you bought in January of this year, create a tax loss to offset the gain on sale that you're getting now with the property that you're selling today. That is a lazy man's 1031 exchange. Basically, you're creating a tax write-off to offset the gain on sale without going through the 1031 exchange procedure. So I just want to point that out because a lot of people seem to kind of get lost in this area. But the key point is that if you can create losses through an acquisition, those losses can offset any gain on sale generated during that calendar year and any future calendar year. And it's just really important to understand that fact. So this is it. That's it. This is my contact info. You're welcome to email me. If you email me, put in the subject line that you heard about me from this presentation, the W2 Capitalist presentation. That'd be very helpful for me. And either myself or my executive assistant, McKellar, will point you in the right direction. If you want more information, or we have this whole guide on the short-term rental stuff. So I know I kind of breezed through it, but there's a guide it's literally step-by-step, all the citations. A lot of people will actually use that and then go gut check their CPA, which is awesome. But you can check it out. You can download it there, realestateCPA.com/str-guide. So thank you guys. I appreciate you letting me come on here today.
Brandon, thank you for that. I know it was a lot. We could go for hours, and after, I'm glad somebody in the world like you enjoys going through this stuff, because I don't. And I do have a great CPA. What I've discovered is my frustrations with him is misdirected anger from just the government in general. And I'm like, man, I don't want to pay taxes, period. He just happens to be the guy that's in the middle. And it's like, and so I've come to that realization. I probably owe him an apology for years past. But Mike, Ramel, Gway, you guys have any questions? Brendan, you got time for a couple of questions, maybe?
Yeah. And while you guys are thinking of questions, just as a spokesperson for the CPA community, I'm not a spokesperson. Just pointing myself at that. Yeah, look, like we're all on your side. We don't like paying taxes either, which is why we do this, right? We want to help people optimize. But a healthy challenge is good. And so you have to recognize, when is my accountant challenging me to do this right, versus when are they challenging me because they don't want to do it or they don't want to do the research necessary to pull it off. And those are two different types of people. And it's hard to figure out who you're working with, but that's your challenge. You have to try to figure out that piece, because I have seen, we've had clients come in that will say like, hey, yeah, my old CPA was terrible because of XYZ. But then you come to find out, like, well, that CPA was actually great. It was a healthy challenge. It was we want to make sure that if you're audited, you're good, because the fear about audits is all the rhetoric around like how challenging and painful they are. Well, that's all coming from people that aren't prepared, and they don't do what's necessary today to protect themselves. But if you protect yourself, those audits are breezes. They're not hard. The IRS auditors are not out to get everybody. They got random samples that they got to complete. But if they find those weird ones, they'll expand those audits real quick. So that's what you got to watch out. Yeah. What questions do you guys have?
I got a question.
Sure.
Yeah, I'm glad. I followed you for a while now. I'm kind of sad that you're kind of breaking off from your partner. You're doing like another podcast with those bigger, better deals. But I'm excited for you. But anyway, I had a question. Like, I know that you can do a cost segregation. The year that it's got to be put into use is what matters. So I have a short-term rental in like Pinehurst, and it was put into use 2 years ago. So I can technically qualify for like 100% bonus depreciation. But going back to your question about like, putting in a property manager after you materially participated. Well, I have a property manager I started with. Now, can I do the reverse? Now, let's say I take over property management after the U.S. Open, which is like, in a few months. But I take over. I do the material participation. I'm doing I'm self-managing. Now, can I use that short-term rental 100% bonus depreciation when I take over after the after I do the 100 hours, or does it start from right now and I can just take if I take over next year, it'll be 60%?
That's such a good question. Is it Pinehurst, North Carolina?
Yeah. Both of my places in Pinehurst. I'm in California.
Huh. So, I'm in Raleigh. I'm like right up the road from Pinehurst. Yeah.
Yeah.
Cool.
For sure.
My good friend growing up works at Pinehurst. So anytime I go, I call him up and he hooks me up. It's awesome.
He's not Wesley, right? Is he Wesley Jackson? No, right?
No, his name's Chase Lippard.
Oh.
Yeah. Okay. Anyway, to answer your question, great question. The answer is yes. You can go in reverse. So I talked about you materially participate year one, and then you place the property manager. Now you're passive. But another way to do it is to not cost segregate in year one and just wait until the year that you do become a material participant, right? And so we actually do this. A few of our clients, it's more rare, but it does happen. So a few of our clients will accumulate a real estate portfolio over time, and then one of them being them or their spouse, will quit their job, sell their business, and in that year they can go and qualify as a real estate professional. When they qualify as a real estate professional in that year, in that future year, we can retroactively cost segregate every property, and we can spike that year with all the losses and all the bonus depreciation that should have been taken had we cost segregate it at the beginning. So to answer your question, yeah, you can kick your property manager off and you can step into the role. And if you haven't previously stripped that depreciation out via cost segregation, you can do it at that time. It is expensive because it's very complicated, but it's like I've not seen a case where it's not well worth it, especially as that portfolio has accumulated. Great question.
Good question. Mike, you got anything?
Well, I appreciate
the old man shaking his head no. I have one question. And this goes back to, you said something earlier about us as real estate investors. We're really entrepreneurs, right? And we're business owners and whatnot. And when you make that shift from having a W-2 to being a straight entrepreneur, banks look at you differently, right? And so for the last couple of years, and I think after we're able to file 2023 taxes, it's going to change. But for the last few years, I mean, we were fighting hard to get all the depreciation we could, always. And so on paper, I am not very bankable. And so, from a traditional banking standpoint, right?
Sure.
And we can go get DSCR loans all day long, but, because they look at the tax returns, and most traditional banks, they don't know how to add back in that depreciation and say, oh, actually he made X instead of what's showing on his return. And so, just as you were talking about depreciation earlier, are we required to take depreciation on the 27 and a half year? You're required?
Yes, you are required to take depreciation. If you don't take depreciation, the IRS will assess depreciation whenever you sell. So they're still going to assess depreciation recapture tax when you sell, as if you took depreciation, even if you don't take depreciation. So effectively, it is required. Now, on the banking piece, if you're running into bankers that aren't adding it back, I mean, this is a Fannie Freddie guideline, so it's not exotic. I would just push really hard and say, I want to work with somebody else, or you need to run it up the chain and you need to have it explained to you, because this is not how it works. Typically, when you
did that, I did that with two different banks, and all of a sudden I'm getting no responses, no callbacks, nothing. Can I talk to your boss? Like, you're not doing this correctly. You're like,
sometimes we'll jump on the phone with clients and their bankers and help explain. But most of the time it's not an issue, especially if you find a banker that knows what they're doing, has worked with real estate investors before. But that's it.
I haven't found one that. I mean, we had. A few years ago, we had most of our banking needs at Compass Bank, BBVA. They were bought by PNC or acquired by PNC, and there was a stretch of 3 to 4 weeks where I had zero access to any of our accounts, which was most of our accounts there, and I was making daily trips to the office here to make withdrawals, to make bill pay, because we're all online bill pay. Like, I had no online app access, and I had to go into the branch to do any kind of transaction. And that scenario made me realize we're going to spread out. We're going to go to 3 or 4 different banks with all of our operating accounts, all our reserves, and this is not going to be this crazy again. And so I haven't, and since then I haven't really focused on building a relationship with one single bank that works with investors. So,
well, it's probably smart to diversify the relationships a little bit. Okay. Cool.
Cool. Brandon, thank you again. Really appreciate it. I know we went over, but as always, great. But by the way, guys, if y'all are on LinkedIn, you're not following, Brandon always puts out some good content, and the guys that work for him too. I don't know if you guys are like trying to take over like LinkedIn from a CPA, like, but you guys are doing a good job. I'm very jealous of what you guys are doing over there. So, but thank you again. Really do appreciate it.
Thanks, guys.
Thank
Thanks
you.
for everybody, and I appreciate your time.
Thanks.